Hi everyone, this is Business is Personal, and I'm Dr. Corrie. Welcome back. I'm here with my guests Tarek and Craig, and we're talking about investments today. So before we begin, guys, I want you to take 30 seconds and introduce yourselves, your roles, where you're working, and your interest in investments. Go ahead, Tarek.
Sure. My name is Tarek Kabrit. I'm the CEO and founder of Seez. I've been on both sides of the fence. So prior to founding Seez, I was on the investment side. I worked with Mubadala, with Faisalia Group, Abraj Group, and I was also a venture partner with Wamda. Seez is a mobile app that aims to automate the car buying process, and we've launched in 3 countries, and yeah.
Excellent. Craig?
Hi, Craig Moore. I'm the CEO and founder of Beehive. Beehive is a SME digital lending platform. We help SMEs that are looking for lower cost, faster finance, and connect them over a digital platform to investors that are looking to broaden their asset class base as part of a diversified portfolio. Today, we've funded over $100 million in the UAE for SMEs, and we continue to drive innovation through different digital technologies we bring to the market.
Brilliant. Welcome, guys. Thank you. All right, so as we start on our conversation about investments, let's start. We want to take care of the stakeholders from the VC side and from the entrepreneur side. Okay, so both of you have experience on both sides. Let's start with the VCs. Where are the pain points? Where are the VCs struggling these days in the industry?
So one thing I hear often is having proprietary deal flow. So still as a percentage of GDP, the money available on the VC side is very small or little compared to international benchmark.
Right.
And typically deals that are, once they reach a certain size, almost all the VCs see the same deal. So there isn't really any competition on the VC side.
Right.
So, which also means there isn't any proprietary return. So a lot of, look at Kareem, there's 2-3 of the big VCs are in it. You look at any big company, typically they tend to have that. So I think having larger funding, which in turn will mean bigger deal flow and start creating more competition for the VCs, I think that's a pain point, and I think with time they'll get closer.
Excellent. Yeah, excellent. Craig, do you agree?
Yeah, I do. I think also that would help just on the entrepreneur side as well, because one of the behaviours you see that when most of the VCs are seeing the same kind of deals, it's very difficult for an entrepreneur to arbitrage between VCs. So if we look at the UK or the US, they will try to create a bit of a Dutch auction as to which VCs they get in, and that's not just the financial terms, but also strategically what can they bring, etc. But it's very difficult if the same deals get shopped across all the VCs. One VC takes the lead, drives the price point. There's no negotiation.
Yeah, that's right.
There's very little negotiation that can be done by an entrepreneur. So I think that's the corollary to that point, and it probably highlights the fact that for a VC community to keep growing and add value, it's got to be symbiotic with the growth of the entrepreneur ecosystem as well. Yeah, so they actually need each other to grow. I guess the pie.
So on the entrepreneur ecosystem, how do you think Dubai, how do you think the UAE in general is doing in terms of supporting entrepreneurs and entrepreneurial ventures?
I think it's clearly the standout in the region.
Sure.
Yeah. So it not only attracts people who are looking to set up businesses, it also attracts people who are looking to work in startups as well. So you've got a lot of people that will come to Dubai to work in startups. The ecosystem is growing. You've probably got a dozen or so accelerators. It's clearly on the map internationally for accelerators to come here as well and set up. So I think Dubai itself, it's doing a good job. It's still probably behind, London or San Fran or probably even Singapore. But it's definitely getting there, and it does attract the talent from the region.
Well, and it's not just London and Singapore. It's not just the big players. Some small players are incredibly innovative. I was very recently at Latitude 59 in Tallinn, in Estonia, looking at the startups and accelerators there, and the ecosystem that they've developed as a country for encouraging entrepreneurship, but everything right to e-residency, right? That whole concept that you never even have to come to the country to start a company, open a bank account, register, pay taxes, all of those things are handled entirely decentralized. So that is a whole country as a startup ecosystem. And I agree with you that the UAE is a little bit behind some of the bigger players, but smaller players like Estonia are moving very, very quickly. So do you see any others like that in the ecosystem in the region or globally that are competing with the UAE?
I think on that front, I think the whole ecosystem really needs to come together as a whole. So having 80% here, and then when a few other things aren't still working, I think it's a problem. So you need also the education systems to really start catching up. And I don't think we have that at that Stanford level kind of thing in the UAE. And I think that's a big part of the puzzle. The other things are small things, like talking about the problems. Like there's a lot of good stuff. So there's the accelerators, there's the funding, there's the ease of doing business and all that. But then, for example, yesterday we were trying to get a credit card for one of our employees, and Seez wasn't registered with one of the big banks as a company.
Oh, yeah, of course.
And a lot of startups are not. So
That's
if you want to get a bank loan and you work in a startup, you probably can't even to buy a car, even if you have a good salary, even if you had that salary for
But now we have Beehive, right?
to borrow money from
That's SMEs, right? We're not in the personal lending space. But no, I completely agree. And you probably hit the nail on the head when you talk about what you were seeing in Tallinn, in Estonia, is that when we talk about the ecosystem, it's not just about what's happening business to business, but it is about how do you register a company, how do you open a bank account, et cetera, et cetera, et cetera. We've just been opening our Bahrain office. I needed to get some paperwork done from a notary here, and it just took a long time to do. And the problem is in smaller businesses, that absorbs somebody's time. And they could be working on a product, or they could be out selling a product, or they could be doing something else rather than paperwork. And paperwork's the bane for all SMEs. So I think the UAE is making a lot of great strides in now starting to digitize those services. And I think I'm right in saying I read somewhere that you will be able to open a company here without a residency. Right. So going back to the Estonia, that they're making all the right noises and moving in the right direction.
So I think country as accelerator is a concept that needs to be itself also grown. So we need countries to start behaving like economic accelerators rather than these traditional organizations that you had this at Beehive also, that you've had a regulatory response to your coming into the market.
Yes.
Did you not?
Yes.
And you provoked a regulatory response.
Yes.
How did that work for you?
We launched in 2014.
Right.
What we had done is we'd set ourselves up to follow regulations predominantly out of the UK, which was the leading regulator in our space at that time. And we engaged early on with the regulators, different regulators, taught them through what we were doing, how it worked. And I think that's one of the important things. You've got to be very, very transparent, because a regulator needs to understand business models before they can regulate.
Of course.
There's no point in just bringing regulation in straight away. So we went through an education process with them. They then looked at other regulatory regimes, consulted with us all the way through the process and others, and eventually brought in regulation under which we fell. Right. But that took a number of years. Right. And I think what's important there is you've got to keep that dialogue going. Right. You've got to be very transparent. You've also got to be careful, because it's a balancing act for people when they go into sandboxes. Sure. Because sandboxes, on the one hand, are trying to give safety and reduce the size of something. But the flip side is, if a business wants to grow, it wants to grow quite quickly. Yeah. And a sandbox does put constraints on them. Okay, so it's a balance.
Did you find in your experience, sorry, I'll get back to you, because the regulatory challenge it's been a challenge for our only unicorn, Kareem.
Yes.
When they came in, of course, they provoked that regulatory response as well. Yes. And then between themselves and Uber, and they found some way through with the UAE government. They responded, they worked out a deal, and then that led to our very first unicorn sale in the region. So that experience, I think, is really valuable. When we come up with new business models that challenge the regulatory frameworks that exist, and we provoke a regulatory response from the governments that are supporting, or governments as accelerators that are supporting our new ventures, did you find the UAE government to be responsive and empowering during the process?
Yes. Good. I would say that we we got the support. They still trod lightly.
Yeah.
It's because they were still understanding exactly how our model.
Were there heavy restrictions on your model during the time that they were reviewing it?
No. When we eventually flicked over to be regulated, clearly some of our business practices got constrained, for example. So limiting, which is all sensible. You're limiting how much a retail investor can put on a platform, for example, or the disclosure amount of information that you have to put on. And that's a balancing act, because what you don't want to do is you don't want to hamper businesses once you bring them into a regulatory. You're giving regulation and comfort to users and the ecosystem, and it's a fine balancing act to make sure then you don't constrain the growth of those businesses because you want to encourage them. The fact you've regulated them, you want to create potentially national champions, etc. You also want to put a signal out to the wider regional market that we've regulated this company, and therefore that means they've got to follow a certain amount of standards, they adhere to a certain conduct of business, and you hope that should make it easier as you try to go for regulation into other jurisdictions. Because whilst they may not have a full reciprocal deal, there is definitely an understanding, they're regulated, so we can take certain comfort in their internal controls, procedures, etc.
I think it made a big difference, the fact that such models exist elsewhere in the world and it was proven and they have been regulated versus a totally new idea.
And I think you've got to be realistic about that. It's that when you see other regulatory regimes that are either granting those type of regulations or allowing them through sandboxes or allowing them through whatever structures, that it makes the regulator a little bit more comfortable because they can seek advice and opinion from outside the region for lessons learned. But the one thing, whether it's fintech or whether it's Tarek's business on the car side, is if you are going to welcome and encourage disruptive industries, they're going to continue to disrupt. And they will go faster and pivot, and the speed at which they will move will always outstrip a regulator. That's just common sense. So you've got to make sure that you're looking always at the spirit, not the last letter of the law, because it's the spirit that hopefully encourages the winners, and you build your champions and your unicorns and all that good stuff.
Okay, so for our government players out there that are looking to deal with new ventures, new entrepreneurs, be as empowering as you can and be as clear as you can in your communication with them, and invite them to participate with you in the regulatory reframing process. Because if UAE as a country / accelerator is going to invite the disruption that is going to define the economy for the next 10 to 20 to 100 years, then you can expect this kind of thing to happen a lot. And the more it happens, the more successful you are as a country. Okay, Tarek, you've been on both sides of the VC and entrepreneurs fence. What are the lessons that you've learned? What can you pick up and what kind of advice can you give?
On which side?
Oh, both, because the VC is obviously choosing the right investment, choosing the right entrepreneur. I think for them, the pain point is not just the business model, but the right people, making sure that the right people are on board. And then for the entrepreneur, like you brought up, Craig, is choosing the right VC in an environment where they're constrained from choosing the VC that they want. So how does an entrepreneur choose a good venture partner?
Assuming they get to a stage where they can choose, which is already a pretty good place to be. I think they really need to think about how active those VCs are in genuinely helping. So you think about, do I bring in a partner that's going to pull me back and just be asking for a lot of reporting, blocking things on the board and all that. So that's the negative. And then there's a neutral partner that just doesn't give you a headache, but also doesn't add a lot of value. And on the other side of that spectrum, there's actually VCs that pull their sleeves up and actually help out. There aren't a lot of these regionally, unfortunately, because a lot of them are also struggling with their own fundraising, and they're spending a lot of their time going around raising their next fund and trying to close those. But just talking to a few of their portfolio companies, seeing how genuinely they help out. Talking to other VCs, just getting, because there are some reputations in the market. So certain VCs are known to be X, others are known to be Y. So really asking around is a big thing. And then your actual rapport and relationship with the partners on the VC side who are going to be on your boards. Like, do you like them as people? Do you want to hang out with these guys or not? So that's on the fundraising side as a founder, assuming you have options. If you don't have options, my advice is try and bring people on board, whether formally, informally, as advisors, whatever, to really help you out with the process. Because I realize it makes a huge difference to know how to talk to the VCs, to talk to the right VCs, to not waste time on the ones where you shouldn't be wasting time. So we get some VCs that come and say, oh, we like you against and sometimes it actually is smarter not to even send them our deck, because we know this is not going to go anywhere. And if you do it with all of them, then you really don't have time to do it with the key ones. So coming from the VC side, for us at Seez, I knew how to speak their language. I knew how to tick the right boxes that they like to see. And just the dynamics of the relationship, having been on their side, then we come here and you talk to them, they see you a bit differently. You're not,
So let's lend a little bit of your particular experience to this for other entrepreneurs in the region. What are the 3 boxes that they need to tick that they're not seeing?
So it's the same common boxes. It's the team, the size of the market, the growth, like competition, all that. So the key boxes to tick are the same for everyone. It's a question of, but you'll never tick all of them. And it's a question of which ones do you tick and which combinations of ticks actually works for the VC to build a better story. So for us, for example, we do a lot of work on the AI side. And the bulk of our tech team is from Denmark. So that, for better or for worse, it wasn't an active thing we did, but helped us a lot. It allowed the VC to say, oh, this is a bit unique. It's a bit different. They're bringing AI guys from Scandinavian country. It helped us connect with them on a different level. So small things like that, as silly as they sound, actually make huge differences in your pitch. And also because in any industry, like you have 10 companies doing something similar, and the VCs are talking to all of the 10 of them. So you just need to really try and stand out in some way. And until you have a huge user base, big revenue, and you're really growing, the way to stand out is with your story and with your team. So
that's good. Craig, would you agree?
Yes, I think language is really, really important. Tarek alluded there to AI. There are certain trends as well, and particularly if you're in early stages of your business, the messaging and the language used and the terminology and whether that's resonating and it's on the VC's radar at that time can be the difference between funding and not funding. Yes, they have to like the individuals, they have to think you've got a strong team. But as Tarek says, if there's 4 or 5 companies all trying to do a similar type of thing, the one company that is standing out talking about, we're going to do this, we're going to do that, we've got these intentions, and can paint a good story, because everything is unknown until you can really get traction. So traction is another important thing.
But do intentions really sell? I mean, every entrepreneur is hoping that intentions really sell.
But fundraising is still selling, right? It's still a sales job. You're just selling yourself and you're selling your company rather than trying to sell your product. So you need, if you don't believe that the business is going to be a success, then the VCs not going to believe either. At the end of the day, the VCs, particularly those that are coming in at seed or Series A, are looking for a decent type of return. They're not looking for a PE return, they're looking better than a PE return, because they expect a lot of their portfolio to not make it. But one of the things that I definitely say to any entrepreneur or anybody starting out, do not underestimate the time consumption of fundraising. Right? Everybody tells you, and you don't fully believe it, the 2 things: you need to allow enough runway to raise. VCs do, very rarely will a VC, unless you've got a Dutch auction and you're the hottest thing in the world, will you close a deal in 3 months or 4 months. It just doesn't work like that.
No, they're slow-moving machines,
They're slow-moving, but they're slow-moving for a reason. They're kicking the tires. Did you do what you said you'd do last quarter? Well, that's another proof point for us. Summer's coming round, why don't we pick this up after summer?
That goes back to the first point we discussed earlier, which is little competition between
Yes,
VCs.
because
if
no-
there
no,
was
there's-
competition,
you
then-
speed that up.
then they
Absolutely.
would speed that up because they have nothing to lose. They know you're going to be around.
That's
you're
right.
going to still talk to them, even
Yeah.
if they wait 2 months or 3 months.
Yeah.
That's part of the problem. One thing that's also the other thing on the VC side is at different stages of the startup, you need to do different things, obviously. So
Right.
when you're at the seed and Series A, it's more about the story, more about the team, more about, and making sure for that stage, which a lot of startups don't do, is build your product early on in a way that allows you to gather metrics and some data to prove what
Yeah,
you're doing.
exactly
So
right.
it can be like 50 people that you just spoke with and they used your product and did X, Y, Z, and your conversion on that was 10% higher than the average in the market. So people just think just because it's small and it's not, like it actually makes a difference. Getting
Sure.
those data points early on will help you. As you get bigger and bigger, then it's your user base, the engagement, and then it becomes revenue, and then it becomes profit. So
Yeah,
make
that's right.
sure you don't try to sell too much revenue when you're early on.
Yeah.
And make sure you don't like mix these things up. The other thing that I think is interesting that's happening regionally is corporate VC.
Yes. Yeah.
That's booming like crazy. And I think if that really comes into full force, that will create some competition with the other VCs
That's
in
great.
a very healthy
I think
way.
it's disruptive. I think
Yeah.
it's going to disrupt into this region.
Yeah, that's great. Where are you seeing that now?
Saudi,
Okay.
right? You're also seeing that in the UAE.
Yeah.
And one of the things that inevitably is going to come from that is some of the traditional VCs will probably find themselves missing out on parts of deal flow that they thought they would get into,
Yeah.
but they may get in at the seed, they may be there in the Series A, and the Series B, people are looking for a larger fund
Yeah.
or a corporate,
Yeah.
or somebody, maybe even a Western fund that's going to come in
Yeah.
that can write those checks that sit, because there's still a gap here. There's still a gap between,
Yeah,
you're
yeah.
raising anywhere between 2 and 10.
Right. But it's not
It's
a blue
still
ocean
tough.
anymore.
Hmm?
It's not a blue ocean
No, it's
anymore.
not. No, it's not.
We have lots of really big fish coming into this ocean because,
Yes.
like you said, there's no pressure on VCs right now. They're taking their time. But with the corporates looking at this space and looking at investing, yeah, that kind of deal flow, that kind of capital coming in is going to create the competition that's going to push the VCs to respond. So if you're with a VC, action point right now, start to run. You will need to know how to run in the next couple of years because your competition is coming and they have a lot more capital than you do. So run.
I'll give you an example of this. We're raising our, I don't know what to call the round, we're raising a round now.
Yeah.
And we have 2 new VCs, 1 existing VC, and 5 family offices
Yeah,
that,
there you go.
that are
Yeah.
coming probably in. So, and it's like that across industries because
Yeah.
these family groups have been around forever. They typically made their money through traditional businesses,
Yep.
trading
Yeah,
usually.
yeah.
And they have the deep pockets, but they realize that if you just continue the bricks and mortar type of trading, you're
Yeah,
not
yeah.
going to get far in
That's
the
right.
future. So now they're trying to reinvent themselves, and some are doing it better than others, some are not, but all of them are trying in some form or
Yeah,
another
yeah.
to look at VC deals, and they like to go direct because they feel like it gives them more strategic value. They don't want to pay the VC fees and all that, and that's, I think, if you have the channel as a startup founder to these people, I think it's a really good.
I've seen that as well. Family office as VC is something that's it's turning really quickly. But the caution that they have is that they're not industry experts. They don't know how to value a non-traditional business. If it's not made of brick and mortar, how do they know how much it's worth? How do they know how much they need to invest? And then how do they know how much of the story is just story and intention and how much of it is actual metrics? So if you're an entrepreneur, again, going back to what Tarek said, data points. You have to have something measured in order to be able to convince these family offices as VCs, the corporates or the traditional VCs, that what you have is worth something. You need some kind of metric, even if it's small.
And maybe the winning model ends up being a combination.
Yeah.
Like maybe 1 VC and 2 family offices. So
Yeah.
the VC gives the family office the comfort on the valuation, on how
Sure.
they're looking at things. They bring in the strategic angle if it's an
Sure.
industry that they understand. So
And then the VC pays on the share side.
yeah.
Absolutely, absolutely.
Very good. Yeah, very good. So for the entrepreneurs, for those who are just starting out, just coming in, like you said, not underestimating the amount of runway you need in order to get off the ground, that's a really important piece. What is another?
If I look at our experience,
Yeah.
which is quite unusual, we were looking to raise money in 2014. I think it's fair to say the VC community here was fairly nascent in 2014. We ended up raising off lots of individuals.
Yeah.
So we actually raised off 42 individuals.
Oh, goodness.
And we raised $2.5 million
Wow.
off 42 individuals.
What a drive, though. How long did it
Well,
take?
you say that, we raised that in 6 weeks.
Really?
So far quicker than ever going to a VC.
But that was a communication strategy.
But that was a communication strategy.
Okay,
right?
did you
And
do
that's
that
going
in-house or did you hire?
No, fully in-house.
You fully in-house communication strategy?
Both our rate. We raised 2.5 million, then 3 million,
Yeah.
all from individuals.
Wow.
Right? So, what I guess the lesson I'm really saying from that is you've got to find a way.
Yeah.
Because there will be times where your business model may not be flavor du jour with VCs, or you believe in it, but you have to get some traction, you have to get some initial. And I would argue, if you're looking to raise up to say 500,000 or 750, there are numerous ways you can go about that.
Yeah,
And it actually might be a few angels.
Yeah.
Because there are a lot of people here that are willing to invest in early stage businesses. They'll put 25k, 50k, 7,500.
Yeah.
And maybe if you find a couple of those to do the initial, get that MVP, etc., then you might start the conversations with the VCs. But no, we raised in about 6 to 7 weeks. We raised that cash.
That's a very good point, because I see a lot of startup founders saying, we barely have a prototype and we want to go raise money from a VC. What do you think? How should we? Like, it'll be super tough. Like at that stage, just go raise money from.
We didn't have a product.
Yeah.
We didn't have a product. We knew what we needed to do to finish off the development. But we needed the cash to finish off the development.
Fair.
So it goes back to what we talked about before, which is you need a story that people can believe. You need to excite people. You've got to have that belief and passion, because you've got to sell that. But also, we were able to get a wide enough base that for some people it was it's a bit of a pun. I like it. I like the space. We had investors from as little as $25,000. I think our largest investor was about $300,000.
Wow.
The UAE is a perfect place for something like that, because you have a lot of consultants and bankers that are professionals who have decent savings. And they're working like crazy, so they don't do anything else. But then they hear all their friends who put money here and these success stories, and they want to be part of that, success in some form.
So a UAE entrepreneur, great idea, barely a prototype, good concept, strong story. They just need $500,000 to get the prototype finished and the model all built. How do they get audience with these people? Like, they're listening to you, Tarek, and they're saying, "Oh yeah, that's all well and good, but I don't know those people. How do I find them, or how do I get them to find me?"
One of the benefits, so you're going back earlier, we were talking about what are the benefits that the UAE has got to offer. The same way you're talking about Estonia. One of the things that particularly Dubai has is Dubai is a very small place once you get to know a number of people, because people know people. The other thing that fascinated me when I first came here is it's relatively easy for junior people to get meetings with senior people. They'll get a coffee, more than you ever would in London.
Fair.
Right? So suddenly I'll take time out to meet somebody. Saar was a great example. So when the guys with Saar were looking to set up, Mark, he approached me, could I have a coffee? We're going into the accelerator. It's the usual thing. So reached out, and then I gave him some of my thoughts and advice over a period of time. But it was relatively easy, I think, for him to get coffee with numerous different people to build up his network. And then that eventually results in them being able to get their first seed funding, and now they're raising again, etc. So it's easy to get access, probably more than anywhere else in the world. So you've got to use that to your advantage here.
So the sales cycle for an entrepreneur is 1,000 cups of coffee.
That's your budget.
Oh, very good.
True.
All right. So in terms of ease of doing business, we mentioned that the UAE is a very easy place to do business. Is it easy to move from the startup stage to the SME stage in the UAE? Or how quickly does a new company need to look at expanding?
I would say one of the challenges that not just this region has, but other regions that are still more fragmented, such as Southeast Asia, etc., is that everybody looks at this as a region. It's not. It's made up of many different countries with different laws and whatnot. So a lot of people come to set up a business in the UAE and then say, right, and I'm going to use that as a springboard into Saudi, Bahrain, etc., etc., etc. And it's never as straightforward as that. Right? It's not like going into the European Union and then being able to go straight across. And Southeast Asia is the same, right? So it's no different. So it's something you need to be mindful of, is what is your growth strategy? Is your growth strategy growing country for a period of time?
Yeah.
We're guilty of it. I think nearly every startup's guilty that in the first 12 months when they're doing media here, they always say, oh, we will be going into Saudi.
Yeah.
That's our ambitions. It's tough getting into the Saudi market.
Yeah, it's a whole other, it's a whole other world. Regulatory.
A whole other world. So people, it's always going to take you longer than you think.
Exactly right.
Yeah?
Exactly
You've got to put the work in. You've got to do, and that's the same as if you want to go into any other market. But you've got to understand, what is my international strategy? Yeah. What is my domestic strategy?
Sure.
I think that's really important. And for some people, it will only be domestic. But for others, to reach the scale, Kareem would not have sold what Kareem sold to.
That's right.
If they were just in the UAE.
That's right.
So they knew they had to go out and they had to build their presence.
But I think that's an important differentiator that you said, that don't look at your regional strategy as a regional strategy, look at it as an international strategy.
Yes.
Because that change in vocabulary is going to help them to see the challenges of moving beyond the UAE into Oman, into Saudi, into Bahrain, as you're experiencing now. I think that's really important. Don't look at it as a regional strategy. It is an international strategy, and there's the UAE as the hub.
So we're going through that now. So we started off in the UAE, we opened up in Saudi and Kuwait.
Yeah.
Now we decided for our fourth market, we wanted to be something totally outside, like international.
Yeah.
So our next market is going to be South Africa.
Great.
And there's no super real specific reason why. I mean,
would you like throw a pin at a map of the world?
It's a sizable market though, isn't it?
Sizable market. It ticks a lot of the boxes we need to tick, but other countries do as well.
Fair.
And it is more of a proof for us to say, can we do something outside the region as well as easily? To go back to what he mentioned in terms of the region being fragmented, it's something I've been thinking about a lot lately. And I think as a technology company, going to consumers, it's not a B2B play.
Yeah.
It's very hard to make a lot of money from the region because it is fragmented on a country by country level, unless you go down to some operational level.
Sure.
So if it's just a pure tech play and you sell a product, we don't have the population per country to make this business a $200-300 million company. So to get to that scale, you either need to have a product that can go internationally, which means it's not a copycat, because internationally you have other people probably doing a lot of that, or you need to go down to some transaction level or operations on the ground. So, and if you look at all the big exits, whether it's Talabat, Careem, so they all had logistics arm where they went got their hands dirty, and it wasn't just like a high-level tech play.
No, I think that's important, is that our spin on that, for the want of a better expression, is that we talk about being a strong emerging market operator. So that if we go into other markets, the experiences we had here in a market that still had a nascent ecosystem, and we had to solve problems that competitors, say in Europe or the US, didn't have to solve because they could just plug straight into a third-party ecosystem. But now we want to use that to our advantage, which means we've had to build that knowledge base, that repository, that additional tech, those plugs. So then when we go into other markets that actually may have more than we had when we set up here. There wasn't a credit bureau when we set up, right? For example. Now every other country we'll go into will probably have a credit bureau that's at least 10 years old.
Right.
So the amount of data we can get from a credit bureau is more than the data we could get here. So you use that to your advantage. Whereas if somebody was coming in from the US, they would look at that and go, that's too hard a market for us.
Right.
Because it doesn't have enough of the things that we would like to plug straight into. So you've got to use that, almost those scars on your back, as a, right, we can go in and we can champion it in markets that maybe some of the others will shy away from.
That's right. That makes you a relatively attractive acquisition target for the international players, because they don't want to come back and learn all of this stuff. They just want to hit the ground running.
All right, so last piece of advice. I have a friend that this morning emailed me, a local friend. He said, look, I've got $1 million dirhams to invest. I found it very interesting that he said, I don't want to invest in an index. I don't want to invest in a stock. I want to either start a company, invest in a startup, or put it into a VC. What's your advice?
My advice is don't put it into one company, especially at the VC
Diversify.
stage. Diversify. Like either start your own business, I think this is what I did spend
Yeah,
my
sure.
money on.
Yeah, I'd say, before you set up your own business, you've got to have a long, hard think about it.
Yeah.
Because it's a very lonely journey at
Sure.
times as an
Sure.
entrepreneur. It's incredibly exciting, but you live by the moment.
Yeah, sure.
So you're a bit like a stock market. When you have a great day, if a Thursday is a great day, you have a great weekend.
Yeah,
If
that's
Thursday's
great
a
hour.
if Thursday's a terrible day, the weekend is a write-off. So
Yeah,
I think he should probably look at maybe 500k into a few businesses and then maybe start his own business with 500k.
Brilliant. Excellent advice. Thank you so much for being here with me today, guys. I really appreciate it. Tarek, Craig, it's a pleasure to have you.
Thank you.
you.